In this video, I'll be showing you the two bucket system. It's the simplest retirement plan that I know that actually works for families with $2 million or more. I'll be talking about why its simplicity is precisely what makes people stick with it, how to set up both buckets so your retirement actually runs itself. Through more than 3 decades of guiding families through retirement, I've discovered that the plans that fail are almost never too simple. They're actually too complicated. And they're so complicated that the family quietly stops following them by year 3. The plan you'll actually follow for 25 years beats the perfect plan you abandon every single time. And that's exactly why I'm making this video today, to walk you through both buckets. How much goes in each, the one rule that connects them, and the limitations you should know before you set it up. So let's get right into it. All right. Let me start with the part nobody warns you about. Once you've got $2 million, the advice changes. Nobody hands you anything simple anymore. It's layered products, tactical this, tactical that, a plan that needs an actual manual to run. And I get why it works. It sounds smart. It sounds complicated. It sounds interesting. And it sounds like what serious money is supposed to do. But here's what actually happens. You stop understanding your own plan. Not all at once, it just drifts. And one day, you couldn't explain it even if I asked you to. And a plan you can't explain is a plan you don't trust. So the market drops, everybody on the news is losing their minds, and you get out. Not because anything was broken, but because you were working on something you never understood. And there was nothing to hang on to when it got scary. You see, that's what wrecks retirements. Not bad investments, but people bailing on a plan they never trusted to begin with. After 31 years of doing this, the retirements that went smoothest weren't the sophisticated ones, not even close. They were the ones that the family could tell you the whole plan in about a minute sitting at their kitchen table. And if you strip all of it away, a retirement plan should really do 2 things. Number 1 is it should pay for your life right now. And number 2 is it should grow for the part of your life that hasn't happened yet. It should pay for your future. It has 2 jobs and they don't really get along. The money you're spending soon has to be safe. The money for 15 years out, it has to grow. So those 2 things, they kind of pull against each other. And that's the whole problem that a plan is trying to solve. Most plans deal with it by throwing everything in one pile and hoping it averages out okay. But that's not a plan, is it? And two buckets don't do that. It's not a pile with our fingers crossed. You have one job for one bucket and one job for the other bucket. And each bucket has its own money and it has its own rules. Nothing's fighting anything. There's no conflict between the 2 buckets. And they're not doing 2 jobs at once. I've had people hear that and just kind of exhale. They say like, oh, that's the first version that's ever made sense to me. And that's why people stick to it, because it makes sense. And by the way, my name is Chris McClure. I've been a financial advisor for 31 years. And I put these videos together about once a week. Hopefully it's honest information for high net worth families who have worked too hard to leave money on the table. Okay, so we've got 2 buckets. Let's start with the first one because it's the one that keeps you from doing something you'll regret when the market drops. Bucket 1 is the now bucket. It's the money you're actually going to spend in the next few years. It has cash, it has savings, it has short-term conservative investments, the kind of money that doesn't flinch when the market has a rough week. It has one job. It's to fund your life for a certain number of years, no matter what the market's doing. When the headlines get ugly, this is the bucket that answers those. I'll put real numbers on how much you should put in there in a minute, so you can see exactly how it's built. And what's interesting is for a family with a couple $1 million, that bucket 1 ends up being a fairly small slice of the whole thing. Everybody kind of expects me to say, you've got to put most of your money into cash to feel safe. But the fact is you don't. Having safe money is important, but you don't have to put the whole thing in it. What this bucket actually changes isn't math. It's actually what it does to your head. It helps you survive those down markets. And let me talk about 2 families for a moment. First is Karen and Ted. They're both retired teachers. They had about 1.8 million. And I come from a family of teachers, so I'm a little partial to them. And then there was Warren. He was a retired trauma surgeon. He had 3.5 million. He had more money than Karen and Ted by quite a wide margin. But guess which one panicked? It was Warren. And I couldn't talk him out of it. He was home, he was newly retired, and he was watching the financial news all day, every single day. And a couple of years back, during 2022, it was sort of an ugly stretch. He watched his account drop and then he sold. He went all the way to cash. And 3.5 million sitting in cash. And after he went to cash, I tried to get him back into the market, but he couldn't just do it. I tried over and over, But the market started climbing, and every day it climbed, he had a new reason that it was about to fall again. He missed the whole recovery. And that decision, that one scared afternoon in front of the TV, it cost him more than any fee would have, or any bad fund, or any bad tax decision. And Karen and Ted, they actually never called. They had a funded now bucket. That first bucket was completely filled. They knew right down to the dollar that the next several years, they were already set aside. They were already safe. They were already handled. So when the market dropped, it was dropping on money they weren't touching for a decade or so. It just wasn't their problem that week. And you see, that's the whole idea behind these buckets. The couple with less money, they slept fine. The surgeon with twice as much nearly undid himself, and it was the same exact market. The difference was that the money that they intend to spend every day was protected in one case, and in the other case, it wasn't. You see, bucket one buys you calm, but bucket two is where the next 25 years get paid for. And it only works because bucket one exists. Everything that you don't need in the near years goes into bucket two, the growth money, and it's a diversified portfolio to outpace inflation over the long haul. We want that money to grow so you can have plenty of it to spend in the future. And it can ride out a full market cycle. If the market tanks and it goes down, we have time to ride it back up because you're not touching it for years. And you see, that's the freedom that bucket one buys you. People forget that a 30-year time horizon, a 30-year retirement is a long time. And money you won't spend until you're 15 has no business sitting in cash or in short-term bonds or in something fixed. The bigger risk I see at this level isn't people being too aggressive. It's portfolios that are so cautious that they can't survive 3 decades of inflation or 3 decades of rising prices. Investing too safely is a way to run out of money in the long term. And so we have these two buckets and they're connected. And the connection between them is one rule. In a good market year, we take gains from the growth bucket and we replenish the now bucket. You're selling high on purpose. In a bad year, you don't move anything. The now bucket actually carries you. And the growth bucket gets left alone to recover. You see, that one rule, it automates the thing everybody knows they should do, and almost nobody does. You want to sell when assets are high, and you want to sell it when you have plenty of money, not when you need it the most. You're not making a gut call on a scary market. You already made it. You made this decision back when you were calm, and you have this one rule. Maybe you check it once or twice a year, and that's the whole manual. Replenish bucket one from bucket two when bucket two is doing well. And it's really why I've got families still running this model after a decade. There were never enough confusing moving parts to break the model. So let me put real numbers on it because this is where it starts to click, I think. A couple I work with named Jim and Diane, Jim had sold a manufacturing business and they came in with right around $3 million or so. And they needed about $120,000 a year to live the way they wanted. Between the two of them, Social Security covered maybe $40,000 of that or so. So the piece their own money had to cover was $80,000 a year. And so we built the now bucket to hold 5 years of $80,000. So call it $400,000 sitting in cash, sitting in short-term bonds, CDs, boring stuff. That left about $2.6 million in the growth bucket. Now that long-term money was invested to grow, and it was money they weren't going to touch until they needed to replenish their now bucket. And then came 2022, and 2022 was a bit ugly. It hit everything at once. Stocks were down 20%, and bonds, usually bonds are up when stocks are down, but bonds were down another 13. And it was both at the same time. And what's interesting is cash was flat. So we had stocks down 20, bonds down 13, and cash basically paying zero. So here's what we did. Jim and Diane's growth bucket dropped. On paper, they were down a few $100,000. And I'll tell you, that's no fun to see, right? No one ever says, I can't wait to lose $100,000 or $200,000. But the fact is we didn't sell a thing. We actually paused the refill, right? We paused that refill. They kept living out of the now bucket, same as always. And the growth bucket, we didn't touch. It was left completely alone to recover, which it did over the next year. That next year or two, we actually refilled bucket one. We moved some of the gains back over and topped the now bucket up to 5 years again. And here's what I want you to catch. Through the worst year in a decade, their paycheck never changed. They still got the same amount of money. It didn't change at all. And they barely felt that down market. That's the same year that wrecked Warren. He sold in that year, but for Jim and Diane, it was a year that they hardly noticed. I'd like to pause here for just a second. If you'd like to see what the 2-bucket system looks like built around your actual numbers, go ahead and click the link below to book a call with me. My team and I will walk through your spending, your accounts, and exactly how we size both buckets for your situation. So this is intended to provide you all the information. So let's talk about what the system doesn't do. I'd really be doing you a disservice if I let you think these 2 buckets fix everything. It doesn't. And here's where it falls short. The 2-bucket system is an investment and withdrawal structure, but it doesn't talk about taxes at all. And at this level, taxes matter just as much as the buckets, and maybe even more. And see, the big question is which accounts sit in which bucket? We have pre-tax, IRAs, 401ks, things of that sort. We have Roths, we have taxables, we have cash. And depending on what your investment mix is made up of, the tax bill on that decision to refill is what we look at every single time you decide to refill the buckets. It's the same 2 buckets, but if you have the wrong accounts, unfortunately, you can hand the IRS tens of thousands of dollars you never had to. You see, this is where it matters that somebody's looking at the whole picture, where, the left hand is actually talking to the right hand. And I have to admit, I'm sort of a weirdo. I actually read tax returns, I read estate documents, I read investment statements all at once. And what I find over and over is a good CPA who's never talked to the investment person, an estate attorney who set something up years ago that nobody's looked at since. And they're great professionals and they're each doing their piece, but there's no one holding the whole picture together. You see, you can build these buckets perfectly and you can still build money, you can still bleed money through that gap, through that lack of communication. And a question I always ask people is, when's the last time your CPA and your financial advisor were in the same room? And the answer is almost always never. So there are some shortcomings to these buckets if you're not on top of the taxes. I also want to let you know who this isn't right for. A system like this, if it were right for everybody, then it's usually right for nobody. So the system isn't right for a few types of folks. If the gap between what you saved and what you spend is really tight, 2 buckets probably won't give you enough precision. Your plan just has less room for error and it needs more fine-tuning than a simple model like this. And if you've got a big illiquid position like a business or concentrated stock options or real estate that you're not going to sell, it kind of complicates the clean picture and it needs its own handling, not just from a tax perspective, but also from an investment perspective. But for most families at this level where they have normal spending, they have investments, they have 401ks and IRAs, maybe some cash, maybe a piece of real estate, those issues don't apply. Which is why this is the system I end up recommending more than any other. You see, it's a chassis. It's a strong one. Let's talk about actually putting it together because it comes down to 3 decisions, and that's really it. The first decision is your real spending number. Not a guess. We want to know 12 real months of what actually is leaving your accounts. Both buckets get sized off this. So if you fudge it, everything downstream is off. 2 is your protection window. How many years the now bucket covers? Is it 5 years? Is it 3 years? What's enough for you to sleep well at night? Not so much that you have tons of cash sitting out of the market, but enough to know that if the market were down, I'm going to be okay for the next 3 years. And the third decision is what's actually in the buckets. Which accounts go into which bucket? What are the tax consequences of each bucket so that the structure itself is running a bill you never need to pay? So that the structure itself is handling your income for you and making sure that the taxes are always at the lowest point. You see, this is the one people actually skip, and usually it costs the most. So for most families, that conversation, those 3 decisions, it fits into one planning meeting. And it's usually the fastest they've ever gone from an anxious pile of money to an actual plan. And then there's the upkeep, my favorite part because there's almost none of it. We need to do 1 big review a year, maybe 2. We want to check your spending against the plan. If you have a good year, we're going to refill the now bucket. If life changes, we're going to adjust the targets. And that's really the meeting. The rest of the year, you leave it alone. And that's the actual design working. If we spend too much attention on it, it's what tempts people into fiddling with it and making bad decisions in an emotional time. And fiddling and making bad decisions is what actually breaks good plans. What's interesting is that once a year review is also where the tax work gets handled, lining up the refill with your income for that year. My clients actually think that the upkeep is boring. And I tell them every time, boring is exactly what a retirement plan is supposed to feel like. Boring means it's working. So we have 3 decisions and 1 annual review. Let's finish with what this all adds up to, because the point of the system was never the buckets. So what does this actually buy you? The buckets were never really the point. What it buys you is your income starts showing up like a paycheck again, out of the now bucket, on a rhythm, same time every month. It's the same rhythm you had when you were working for 40 years. You get that check every single month. And market drops stop being a threat to your life. They're just something that happens to your money that you won't touch for years. It's also super helpful for couples, and I find this very fascinating. They finally land on the same page. The spender looks at the now bucket and sees permission. The worrier looks at this exact same bucket and sees protection. One structure, and both people in the house can finally breathe. So if you want to start this bucket idea, you can start this week and it costs you nothing. All you have to do is pull 12 months of your real spending, not an estimate, but an actual number. You see, that one figure unlocks the whole design. Then you want to look at your portfolio and ask one question of every dollar. Does this dollar have a job? And does it have a timeline? For most people across the whole account, the answer is no. And that's the problem the buckets actually fix. If you're within 5 years of retiring, you want to build this before your last paycheck, so day one starts with a system already running, instead of you scrambling to set it up while you're also figuring out how not to go to work. Families who set this up right tell me the same thing almost every single time. The money didn't change, but the way it felt to own it did. And that's the whole thing. That's the whole reason that we create this bucket plan. Now you've seen the whole system, the now bucket that buys calm, the growth bucket that funds the decades, the one refill rule that connects them, and the honest limits of what 2 buckets can do. If you want this built around your household's actual numbers, go ahead and click the link below to book a call, and my team and I will map it out for you. I want to let you know I really like making these videos. Please like and subscribe, and I'll see you on the next video.